Good morning, ladies and gentlemen, and welcome to the VIANET Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it is appropriate to do so. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. I would now like to hand you over to the executive management team from VIANET Group PLC. James, good morning, sir.
Good morning, everyone, and thank you for joining us today with Mark and Sarah. I'll kick straight into the results. Strong set of results. Beverage Metrics acquisition is now fully integrated. The hospitality division is in growth, and we're seeing real momentum in the unattended retail division. And there's been further progress in new verticals where we've installed over 1,800 devices in forecourts. So we've got an established presence there. And another period where the group is ahead on key metrics. Top line growth agenda is being delivered. We'll turn over to page 2. Quickly, for those that are less familiar with the business or perhaps seeing us for the first time, I'll do a quick run through of what we do. Basically, we help customers transform business performance, allowing them to do more with less. We install hardware that allows us to harvest data and thereby produce dashboards, alerts, alarms, and insights that allow them to address waste, shrinkage, improve productivity, and drive sales. We have two key divisions. Smart Machines is the unattended retail division, where we provide complete vending connectivity and contactless payment solutions. The other division is our hospitality division, Beverage Metrics, where we're in about 9,500 pubs and bars, where we provide the leading comprehensive beverage and bar management system. In the unattended retail division, we cover areas such as the core vending operations, forecourts, and laundrettes. And in hospitality, it's the UK pub sector, predominantly leased and tenanted. And with the acquisition of Beverage Metrics, that's given us the relevance across managed hotels and the wider leisure arena. We have a typically software as a service model. We install the hardware either on the upfront capex or a rental model, and then we enter into an agreement with customers for a subscription model. That varies from 3 to 5 year contracts, and that's for service, licenses, and data. Turning to the financial highlights, I won't steal Mark and Sarah's thunder. I'll just sort of have a quick run through top line. Strong financial results, ahead on key financial metrics, and that's a result of our footprint expansion. Good to see top line growth focus is paying off. Profitability is increased, as is cash generation and our debt reduction. That allowed us to resume a full year dividend at the full year, and we're reinstating the interim dividend. It's a modest interim dividend that we're reinstating for the half year. Moving on to unattended retail, strong momentum. The bottom line is that we tick the box for customers in terms of the quality of our hardware, the customer experience, which rates ahead of the competition, our transaction rates that we benefit from the partnership with SureSight, and the hardware pricing. In the period, we've continued to, for the last 12 months, we've continued to be very aggressive on hardware pricing. Because what we want to do is drive the footprint expansion that's going to drive the recurring incomes. And again, we continue to benefit from being a trusted advisor, having looked after customers during the COVID period. Our gain and retain strategy around about the 3G shutdown and the migration to 4G has paid dividends. We've secured all our existing customers on longer term agreements for 3 to 5 year agreements. and we've displaced the competition in existing customers, and we're picking up new customers where we're sort of addressing the competition. And we've had some good wins in buying groups where we've never traditionally been strong. A competitor has left the payment solutions market for vending, and we're picking up some of that business. And we've also recruited their former EMEA sales director to upweight our sales team. Building a good, strong pipeline with 48 new contract wins compared to 37 last year. That's delivered 4,700 new devices in the period, of which 1,000 are 3G upgrades to our existing estate. Clearly, that doesn't give us new recurring income in those 1,000, but what it does do, it's extended the period of subscription to 5 years. So we're very pleased with the progress. Good footprint expansion, long-term recurring income is building. Turning now to the forecourts. The groundwork that we've done over the last sort of 18, 24 months has really been paying dividends, working with SureSight, developing key relationships and creating strong foundations. The Wilcomatic and Romtech installations are now complete. That gives us a substantial base and a reference point for other customers. The UK self-serve market in forecourts, whether that's rollover cart washes, jet washers, vacs, or air towers, tends to be high ticket, certainly compared with snack and can vending. And the environment that our hardware is installed is quite harsh. So we've got to have high degree of functionality, reliability, and ease of user, and user-friendly hardware that allows customers to really maximize their revenues. And of course, the reconciliation is important as well. We take someone like Wilcomatic, may have a presence in Tesco, Asda, and Sainsbury's, where they may be in a revenue share deal. That means there's got to be, basically same-day reconciliation of the funds, so they can take their share of the sales. And the overall linked opportunity in Europe. Christ car wash systems are one of the major car wash manufacturers in Europe. They have a partnership with Wilcomatic in the UK. We clearly have been dealing with them to develop our hardware to go into their car washes, and that gives us access to their European operations. So it's a watch this space, and we're also doing work with some EV charging prospects in Europe as well, field testing our hardware. So overall, we're making good progress in new verticals. Turning now to hospitality, really pleased with the progress here, delivering growth and demonstrating the long-term resilience of the leased and tenanted sector that we dominate. It's a very stable base, and it's also benefiting as the hurdle rate for running a profitable managed house increases on the back of increased costs. We're starting to see some managed houses being converted to leased and tenanted, where the entrepreneur can spend a lot more, is committed to that business. It's not only his business, it can be his home as well. So they're putting a lot more work in than perhaps the average manager would. So we're very sort of comfortable with the strength of the leased and tenanted model. Seeing new long-term renewals with Heineken's, Star Pubs and Bars, and with Green King in the last week or so. And in terms of securing new long-term business, we've had 3 new contract wins, including Marston's. The other thing that's quite exciting for us is that the big brewers are increasingly interested in getting their hands on data and understanding what's selling when, and mapping that with activities that might be Sky TV or TNT football match, rugby matches, and mapping volume performance versus activity, and that allows them to I guess to promote their brands. Again, ahead on all key metrics, so really pleased. And I think for me the bit that's really exciting is Beverage Metrics acquisition. That really increases our relevance to the wider hospitality market, beyond leased and tenanted. In terms of the FastScan inventory platform that we acquired, and there are now that we're fully integrated our draft beer module with that, we can do full till variance analysis that gives effectively if you have one additional pint a day going through your till, that pays for the system and draft beer quality. The great thing about it too is that this solution, the dashboard is intuitive and user friendly. A pub manager can look at that in the morning, in a minute a day it takes to actually see the dashboard and figure out what he needs to focus on that day, if at all. And as I say, one additional pint a day going through the till pays for the system. In the period, we launched EnerSave energy saving solution for glycol cooling systems for beer. We've got 20 initial sites in 3 brewers, and there's a further 100 or so installations due in the second half. We charge in the region of about £600 for the management hardware installation, and then it's about £15 a month. It won't go across all 9,500 of our existing pubs, but there'll be a fair proportion of them where this is applicable. So it's incremental revenue. Turning the page, I guess the key drivers are the same regardless of which sector we deal in, or whether we're dealing in the States or whether we're dealing in the UK. The bottom line is that the costs are going up in the recent budget, in particular, national insurance thresholds, and also the minimum wage impacts our customers and the pub sector in particular. So the increase in wages, utilities, and the cost of goods. And there's less pricing flexibility than there ever has been, because there's less cash in the pockets of consumers. So there's limited options for customers, regardless of sector, on what they can do to actually generate increased profits. They've got to be able to do more with less, and that's where we help. If we sort of look at the UK pub base, 9,500 pubs, that's a substantial business, no real competition, all on long-term contracts. So that's pretty robust, it's stable, and we continue to drive growth from that. And then Beverage Metrics, that draft beer module integrated with the standalone stock module allows us to actually make some progress in the wider leisure market. If we look at the opportunities in our existing customers, there's about 1,000 sites that do not currently have draft beer monitoring. There's scope for footprint expansion, and that has reduced from 1,200 in the last 12 months. Then we've got a couple of key pilots going on in the UK. A managed pilot has delivered really good results, and we're currently in negotiation there. And then we have a pilot at the Oval, and that's with Levy Hospitality. They've probably got another couple of 100 sites across the UK. That's helped us actually work on developing the product further and looking at real-time data. If you think about a test match, you may have temporary staff working your bars. If there's some shrinkage, you want to know there and then. You don't want to know next day. You want to do it there and then. Moving on to sort of Beverage Metrics and just touching on what that brings to the party now that we're fully integrated. Perpetual inventory management platform combined with a fully integrated draft beer management solution. As I said, it's intuitive, user-friendly, drilled down. And we've learned lessons over the last sort of 5-6 years about not not doing data overload with our customers, so it's intuitive and it's straightforward and simple. And simply the shift point of sale loss analysis by itself, ensuring that everything that is poured is going through the till. One additional pint a day pays for the system. So the bottom line is that should be a no-brainer. And secondly, quality. If you get a perfect pint poured right first time, that means that you can improve your productivity and move on to serving the next customer. So big focus on quality, big focus on line cleaning, ensuring that beer is served through clean lines. And we've got a high degree of engagement both in the UK and the USA. Turning to the USA, I won't go into a great deal of detail. The slides themselves say it all, the chart itself. Bottom line is we're working with key players. We've got Chili's, who have 1,250 sites, Outback of 700 sites, and Darden 1,800. And then we've started working with Aura Hotel Group. They have 40 sites, but they carry the big brands. So they're a Marriott franchisee. So a significant marketplace in the USA. And we're making really encouraging progress. And relatively limited cost exposure due to our relationship with fintech. And that for me is important because nothing ever happens as fast as we want it to happen. But the fact that we have got a limited cost base, it doesn't hurt us too much. We're not burning lots of cash. In terms of the proposition in the States, basically, you're looking at typical ROI 3 to 6 months. The shift point of sale loss analysis report itself gives the payback and the return on investment before you start to look at all the other benefits. Just looking at some of the opportunities, Margaritaville, that is a chain of resorts and hotels that also includes Landshark and 5 o'clock somewhere bars. We're on the franchise technology stack. We've had fast scan inventory solution in there for a long time now, for multiple years, and they're in the process of a business expansion themselves, and we're installing beer for the beer module for the first time in January. So it's again making good progress with them. Then Chili's, we've had 20 sites with them for some time on the legacy iDraft product. They've been upgraded to beverage metrics and have delivered excellent results, both in terms of addressing point of sale loss, but also in terms of addressing beer quality and line cleaning. Chili's, one focus area for them is to serve delicious beer, and we help them do that. Fast scan inventory, and we got a 90 site initial opportunity with one of the benchmark players in the USA, and that's something that we've been working on for a couple of months now, and we expect to see a rollout there during Q4. And Outback, we've got 10 site pilot. We've been accepted onto the test program in the new year. So that will be a draft beer module going into Outback. And then also there's Aura Hotels, and that gives us access to Marriott. 2 initial installations with a further 40 to go at. Bottom line is that we're helping customers address shrinkage and improve their productivity, allowing them to do more with less. Moving on to our partner in the States, fintech. Fintech were born of the 3-tier system in the USA, where the brands, distributors, and the retailers have to be separated, and that's a post-prohibition initiative from the US government that was to ensure that government regulations were being followed, that taxes were being paid, and that there was no build-up of monopolies, vertical monopolies. The system differs by state and sometimes by county. FinTech, basically, they oversee alcohol invoice payment, collection, and reconciliation. And they do that for 40% of all on and off premise in the USA. And they're used by 240,000 retail customers and 5,000 distributors across the states. Great news about this relationship for us is that it gives us unique access to decision makers in chains, and they have direct access to the independent sector that's very difficult for anyone. And the other beauty as well is that the cost of attending trade fairs and shows in the USA would be quite high, but we share those costs with them and share stands with them. Now, why are FinTech interested in VIANET? Bottom line is that VIANET and Beverage Metrics are the operational link to the retailer for the full cycle system that covers ordering, receiving deliveries, invoicing, and stock and inventory management. We provide the ongoing perpetual inventory. We provide automated ordering that goes into FinTech, and then FinTech, transmit to suppliers and oversee the shipping of orders. And then we receive that data again, and then we do the automated receiving for the customer, and that goes back into the perpetual inventory. So a full beneficial circle that reduces labor and increases productivity, and gives a point of difference for that will provide a point of difference for FinTech versus any competitors they have. I'll now hand over to Sarah, who will take us through the P&L.
James, and good morning, everybody. So I'll walk us through the P&L before I hand over to Mark with the cash flow on the balance sheet. Turnover this year was up 500,000 versus last year, showing a 7% growth. And within that turnover, recurring revenues held very strong at 84%, increasing to 6.45 million from 6.28 million last year. Gross margins held strong at a 67% overall, with overhead costs being maintained year on year as what we'd expect, all of which led to the operating profit of 1.43 million, which is a 10% growth on last year, where we were at 1.3 million. EBITDA was up 27% on last year at 1.55, noting that exceptional costs were 200,000 less this year, as last year carried the BMI acquisition. Earnings per share was a positive 0.06p this year versus last year's loss of 0.58, with a small profit before tax of 18,000 for the year versus last year's loss of 171. Moving on to the divisions, for Smart Zones, this is the UK and the US. Turnover was up 300,000 year on year with a 7% growth, and recurring revenues held very strong at 94%. The estate size at September was 9,500, and new installs were 119 for the first half. Gross margins remained steady at 81%, and this led to an increase in operating profit of 1949 versus last year's 1710. Smart Zones UK alone saw operating profit growth of 12% year on year, with the US having like-for-like losses of 250,000 for the period, as we'd explained. Within Smart Machines, turnover was up 190,000 for the year, with 6% growth, and recurring revenues are a healthy 70%. Device sales, as we've already spoken of, were 4,716, and of which 1,000 of those were for 3G replacements, which we've supported our customers with. Outside of those, we then had 3,659 new device sales versus last year's 3,141, which was a strong 16% growth, increasing overall footprint to 37,000 versus last year's 34,500, with 48 new contracts signed in the period, all long-term, This all led to operating profit on par with last year of £1 million. I'll hand over to you, Mark, with the cash flow.
Thank you, Sarah. Good morning, everybody. So strong cash generative qualities of the business continued to shine through. We had an operating cash generation pre-working capital per the statement this morning of 1.61 million. Last year it was 1.26 million, so 27% growth year on year, 345k. That's another strong track record of cash conversion of 104% of unadjusted EBITDA in the period. We had positive working capital of near just over 300,000, principally from reduction in debtors and unwinding of stock, and that improved the cash generation figure to 1.92 million from 1.28 million last year, pre the tax rebate one-off that we got last year. This represents a very positive 124% of EBITDA and 134% of adjusted operating profit. The cash we generated was invested in research and development in tangible assets of just over 700,000. Tangible assets themselves of just under 300,000. We've paid the full year dividend of 221,000 and obviously continue to service our bank facilities in loan repayments and interest. Overall, that led to a very positive 426,000 cash inflow, which is a very positive step forward. Last year was influenced by the refinancing in August 23 on our move to HSBC, so the step forward this year has been very pleasing. We move on to the balance sheet. The balance sheet remains strong, robust. We've improved and reduced net debt and improving cash position. We've talked about the working capital improvement. The cash built to 2.25 million in the period. Last year at this point it was 1.32 million. That's 70% year-on-year growth, with some of that cash now being invested to maximise returns. The net debt reduced to just over 1 million from 2.09 million last year, and I would expect that to continue. So it's a strong balance sheet to support the business ambition that James has been talking about. Back to you, Jim.
Thank you, Mark. Bottom line is that we're in what I think is a really exciting position from a commercial, financial, and also strategic perspective. We've got a strong financial engine. We're in a position to drive, top line growth, which will flow straight to the bottom line. You look at the machines business, gross margins a bit lower than hospitality, but the great news about the machines business is that we don't need to layer on lots and lots of additional costs with the scale, which is good news. Hospitality, it's really in position for a period of sustained growth, in a fantastic position. And the footprint expansion we've got a very strong pipeline with existing customers, and then you throw in the new customers that we've gained in the unattended retail business. Real scope for footprint expansion there, and we'll see the subscription revenues increase significantly in the next 2 years. And the bottom line is that the levers work in our favour. All sectors basically need to do more with less as costs increase and pricing pressures mount. Bottom line is that we're in a fantastic position. We're in the right markets. The drivers work in our favour. We've got strong pipeline in both hospitality and in unattended retail. We've got products that are relevant. We've got good people, and we're trusted advisors. So we're in a very sound position, looking forward to a period of sustained growth. That's it for the presentation. I'll move on to the questions. There's a pre-submitted question here. In your recent trading update, you say the following with regard to the US business. We are encouraged by the advancements in high engagement levels in key customer pilot programs in this significant market. Is it possible to give us more of an insight into the pilot programs, specifically with regard to the number of programs, the size of the programs, and the timescale involved, and the type of numbers involved if the programs are successful? Okay, we've got about 6 pilot programs in process at this moment in time. It's quite a time consuming. It takes a while to get these programs in place. you've got to get, basically sign off to have the pilot program, because as you can imagine, these large businesses in the States have got a number of different initiatives. So getting onto the radar and getting onto the things to do is difficult, but we've managed to do that. Again, helped by the relationship with FinTech. And those pilots typically last, you sign up for a 3-month pilot, but then there's the lead in, the silent period, then there's 3-month pilot, and then there's the evaluation period. So it takes best part of 4 to 6 months for a pilot, and then it's going to go through the approval processes. If you look at the pilots that we're currently working on, ultimately those businesses have the best part of 5,000 restaurants and bars that become our immediately addressable market. Second question here. You reference long-term renewals with Heineken and Green King. Are there any additional major contracts in the pipeline, and how does this impact your revenue visibility? Okay, we'll start with lease and tenanted. We'll start with lease and tenanted. Our existing customer base is now fully contracted on a long-term basis. So we're in very good shape in that respect. And there are another couple of major contracts that we're working on. So two things. Number one, we've got high degree of visibility on our core revenues, which will deliver growth in the coming year. And we've got another couple of major contracts that we're actually working on that will give us enhanced long-term visibility of our revenues. Next question. Given the size of the addressable markets in the UK and US, are there plans to explore additional international markets in the short to medium term? Okay, well, let's start with hospitality. Hospitality, absolute focus on UK and USA. And we pick up bits and pieces elsewhere, but we're not spending money to grow in what are probably less consolidated markets, whereas the UK and US are pretty well consolidated markets in terms of the number of players, and that's where we need to be. That's where we need to be focused. Unattended retail, we can expand beyond the UK in unattended retail. We've already got our presence with Jacob Douwe Egberts and a couple of other players in the Benelux, and we've got the potential to work on developing the relationship. We have Christ, the German car wash manufacturer, and basically take it from there. Next question. How are you managing the lower margins on hardware sales, and when do you expect these upgrades to translate into higher profitability? Well, the bottom line is that any new device installation, when we install a device in an existing installation, upgrading from 3G to 4G, yeah, there's a sort of a hardware margin hit there. But what we do is we secure that subscription revenue, which is very profitable for the long term, 5 years. So that's a positive. When we install in a new site, a brand new site, the bottom line is the hardware is an enabler. We just want to get the hardware out there, because that then gives us a 3 to 5 year subscription revenue contract that gives us long-term earnings visibility. So I'm less concerned on hardware margin, but we still make margin. That's the important thing. Next question. Please comment on the non-renewals on smart machines, as it looks like the rate is running at circa 20%. Related to this, please comment on the split in the number of machines between 3 and 4G. I don't have the 3 and 4G split off the top of my head, but we can answer that in due course. The bottom line is, when you talk about non-renewals, this is about customers refining their estates. It's about rationalization of their estates. It's when they take a machine out of circulation, when they reduce their estate. So we're not losing customers. We're actually, losing a vending machine in a customer because it's been taken off the streets, if that makes sense. So that's as you can imagine, the COVID impacted this, and the whole work from home. If an office that was typically pre-COVID was running at 100%, it may have been running at 70% post-COVID. That's 30% less revenue potential for those vending operators to put a vending machine into an office building. So that's forced them to do a number of things. Going back to their customer, which could be someone like the Royal Bank of Scotland or HSBC or whoever, and saying, well, you need to subsidize the cost of this machine, otherwise we're going to have to take it out. Yeah, or they can just take it out. So that's next question. Knowing that US customers prefer buying from US suppliers, how does VIANET address this issue? I think I would have to say that US customers buy an awful lot of Chinese goods at this moment in time, so it's not strictly true. The second best to buying from a US is buying from a UK supplier. So that's number one. Number two, we have a relationship with fintech that gives us that inside track, and we've been in the States for a while now, and we have a reputation. There's comfort from the fact that one of the benefits of being a listed business is that our accounts everything's transparent, and we can actually our US business is incorporated in the USA as well, and we bought Beverage Metrics, and we've got a small US team. So it's not just about myself; it's about the team that we have there. And that seems to be all the questions for now. I'll hand you back to Jake.
Perfect. James, Mark, Sarah, that's great. And thank you very much indeed for your presentation and for addressing all of those questions that came in for investors this morning. But James, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
I don't think the future has ever looked quite so attractive for VIANET. Probably not since we gained 5,000 new installations with Enterprise back in 2000, 2006, 2007. That was pretty exciting at the time, but that was one sector. We now have growth, strong pipeline across a number of sectors, and in some substantial markets where the key drivers are working in our favor. We've got products that are relevant. We've got strong existing pipeline, strong financial engine, and importantly, we got a tight, young team that are trusted by our customers. So we're in a pretty damn good position.
Perfect. That's great.
Thank you,
James, Mark, Sarah, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of VIANET Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.